Hello, everybody. My name is Thor Young. I'm a moderator at Bear Bull Traders, and I have a little bit of a treat for you today. I was asked by some of the members in the chat room to go over an auction analogy that I often use. Now, me personally, I grew up in the country, which I'll explain a little bit at the start of the analogy, but because of where I grew up, I kind of compare the market a little bit differently, and a lot of our traders have really found it to be a much easier explanation of how supply and demand in the market really kind of works on its most fundamental level. This is for anyone who's looking at VPA, volume price analysis, and things like that. These concepts are going to be really helpful to kind of help you see the bigger picture of what's going on there and why some of the moves that maybe you weren't expecting to happen suddenly happen, and what fuels the things like FOMO and greed into those moments. So I hope you all enjoy this recap I have coming up for you, and as always, keep it green. All right, so one thing I want to talk about real quick. I did an example yesterday that a lot of people have been talking about, I want to talk about it because a little bit you can see here on my DK&G trade a little bit about how the stock market can suddenly rip with the right kind of news catalyst, and I also want to kind of compare it to where I grew up. Now, a lot of you know that I grew up in the country. One of the benefits to growing up in the country is that I've spent a lot of time around auctions. So, and I have kind of an example about how I compare the stock market to the most basic of auctions, which are cattle and hog auctions. So, which I grew up around when I was a kid, as I mentioned. So, when you're looking at the market, you're looking at supply and demand. The market is very technical. There's all these indicators, there's all this stuff, but when it comes down to it, what you are just seeing is supply and demand, right? Why does a stock trade at a level that fundamentally makes no sense for it to be there? It's there because the supply and demand allows it to be there. Because so many people want to buy it, the sellers are able to hold it at a higher price, right? Until some kind of thing happens that forces the sellers to not be as interested in it, causing buyers to be able to buy it lower and lower and lower. Right? And it works really great. Now, if any of you have had the opportunity to go to an auction, then you're probably going to feel me on this one. If you haven't, for a fun little field trip, may I suggest going to a cattle or a hog auction sometime and just watch what happens. So in my example, we're going to have a couple of people. One, myself. So as a kid, my family growing up in the kind of the hog industry, we would go out to sell our hog, and we would go to the county fair. We would go to a local auction, a cattle auction yard. We had all of these places we would go to in order to sell our hogs. Now, I'm going to speak about cattle auctions because that's what I know, right? Because that's where I've been. So as you go there, there's a couple of things that are really important to understand when you're going to an auction that are similar to stock trading. One, you need a really good auctioneer. Going to an auction and having the auction house have an unproficient auctioneer is as bad as trading a stock with where the market makers and the insiders aren't really doing their job as efficiently as they should, right? You get really wide spreads, right? You get really crazy moves all over the place. You don't really know what's going on. There's a lack of structure. There's a lack of liquidity. There's a lack of volume, right? These stocks that we call the stocks that aren't in play, they're just not being controlled very well. So we want to go to the auction where the stock is in play. At the auction yard, you hear everybody screaming out there saying, hey, buying and selling. Well, here, and what we're doing on this, it's the volume that can attract us. So we're going to go to where the liquidity is. We're going to go to where the volume is. So now we would always go to this same auctioneer whenever we would go to our auctions because he was really good at what he does. So here is how it kind of works, and I think if you can apply this to the market, you'll see why a lot of these moves that you weren't expecting to happen. So when you first get to the hog auction, your auctioneer gets cited, something very interesting has happened, which is the auctioneer is basically the market maker, right? So the auctioneer stands there, and he's going to be the one who's going to be in control of the market making. So he's going to try and sell your hogs for as much money as possible because that's where he makes his money. So if he sells your hog and you told him, for instance, I don't want to sell the hogs, for really any less than $50. So he knows that your target is $55 where you want to sell at least. So his job's to get you as much money as possible for those, because that's where he's going to get the biggest, slice of the pie his way. So as the auction starts, you're going to see the auctioneer go into what's called a price discovery period, right? So you'll see here, like between S2 and S3 on DKNG, we have what I would call the price discovery period. So in an auction house, the auctioneer is going to go, okay, I'm going to go ahead and put up these hogs at $75. Do I have anyone who wants hogs at $75? And then no one will say $75. So he'll go, okay, $70. Does anyone want them at $70? And then someone will say no, or no one will say anything, actually. And then he'll keep dropping the price, until finally he gets to a bidder. Okay, I got hogs at $40. Does anyone want these at $40 a head? And then someone steps up and says, I'll buy it, right? So now that he's discovered the price, his low price, if you will, the auctioneer is going to then start to play the price, right? And the auctioneer is going to start saying, okay, I've got $40. Do I got 41? Now, this is going to be a really small increment at first, right? He's just going to go, I got 40. Do I got 41? I got 40. Do I got 41? And then when no one comes in, do I got 40? Do I got 40 and a half? Do I got 40 and a half? Okay, got 40 and a half. Do I got 41? Got 41. Got 40. Do I have 42? Got 42. Right now, the stock is starting to press, but they're in these really, really small increments. And you can see this here, right? On DKNG. We're pressing down, we've bounced, we came back down, we've bounced. We're not really moving away. We're not really moving fast, right? We're kind of discovering what's going on here. Now we got it going. Okay, do we got it at 40? We got it at 45. We got 45. We got 50. We got 50. Do we need 55? We got 55. All of a sudden, something very interesting happens, which is the auctioneer starts skipping the price. And he'll go, we got 55. Do we got 60? We got 60. Do we got 70? Do we got 70? Do we got 80? We got 80. Do we got 100? We got 100. Do we got 150? Right? And the reason he's doing that is because now you've got all these people who weren't even interested in buying the hog at $50 are now FOMOing like crazy, trying to get their order in on these hogs because the price is just going up so fast, right? This is supply and demand. Now notice DKNG, all of a sudden we hit this period, all of a sudden everyone just starts jumping in. Now there was a catalyst that came out on DKNG at the same time, some better news for them, and that helped. So now you've got people going, wait, I should have bought down here. Now the price is up here. I got a business, I'm a butcher. I got to buy hogs. I got to go ahead and do these. So he starts throwing there in there. No, yeah, there's a bidder. There's definitely a bidder, and that bidder's job is to get those hogs for the lowest price possible, right? Because he's got his own money he makes. Now, often the bidder might actually be the butcher or the person who owns the meat factory, right? But it's going to create this momentary pop as they're getting there, right? As it goes up, and now you're going to go up. The real market maker is the auctioneer, right? Because just like a market maker, the auctioneer can control both sides of the spread, right? Technically, he's controlling how much money he's willing to sell the hogs for, and he's technically controlling how much he's willing to sell the hogs for, right? He's manipulating, and that's the one time I'm going to use this word because I normally say massaged, but he is actually able to manipulate the price, and that's why you want the best auctioneer, right? Because the best auctioneer is going to be able to do that the best way possible. Now, look, DKNG got all excited, got in a fury, and in a few minutes ripped all the way up here where I sold all out just to make everyone realize, oh, wait, I didn't really want those hogs at all, right? And here we go. Now we're selling off. We're all the way back down to the low price. But now in cattle auctions, you don't get to take it back, right? Once you put in your bid, there's no selling out afterwards, right? You can't just immediately sell them right back to the auctioneer. That's one of the big differences. You're stuck holding those cattle at that point. But I thought this was a perfect example of how when things really, really get going, and that it's all about supply and demand. You put a lot of this hard effort into all of these different things. Use your technical levels, true, but it's about the volume. It's about supply and demand. It's about when people want to buy versus when people want to sell. Read the tape, read the level 2, and pay attention to those key levels and volume indicators, and you're going to see this stuff coming a mile away, right? And I have a couple of different trades where this has kind of happened. So Anyway, that is the auction story. I hope everyone enjoyed it. We've had a couple of requests for it, so I thought I'd go out ahead and throw it out there for everybody. Hope you enjoy it. Thanks.